Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, January 27th, 2021. What I want to do in this video, we'll take a look at the markets, a few of the sectors and individual trade ideas that I've highlighted recently. Really, where to make money right now, ones that stand out. I've kind of been all over the place with trade ideas in the last few months, with commodities, with individual stocks, individual sectors. And I've been talking the talk for a long time about, the next, getting ready for the next correction in the stock market, and we're still not there yet. We've been waiting for, or I've been waiting quite some time for some decent sell signals. But you remember, the stock market is just one of many things to trade. And when I say the stock market, I'm talking about the indexes. So we'll continue to watch those, and I do such frequent updates on that because that's the tide of the overall, the whatever the stock market's doing, the Nasdaq 100, the S&P 500. And therefore, it's a lot harder to swim against the tide. Although, as I've highlighted, there have been plenty of more and more increasing short ops as well. Long trades have just, some of them have exploded. It's been a very risk-on market. A market that is not even remotely concerned with fundamentals right now. Huge disconnect between the economy and where we are. GameStop is one of those examples. There's a company that, by all accounts should probably go to the wayside here in the next year or so, from what I understand. Fundamentally, but again, that the stock price is a function of a lot of other things going on. So I'm going to talk about that, and we'll get to that one in a second. All right, let's start out with what I think are the most important charts right now, and I just want to reiterate my thoughts on the market. I hate to be the henny penny, sky is falling kind of thing, but these are some of the most reliable indicators that I've used, and I've gone over these time and time again. They are sentiment indicators, and sentiment indicators are contrary indicators. And like I always say, there's not a single indicator that is 100% effective. And therefore, you can't load the boat any one way or the other. And more importantly, these sentiment indicators are far from exact timing indicators. I mean, there is a timing element involved. Sometimes you get these signals and then the reversal. I have bullish buy signals and bearish sell signals. Sometimes those reversals come immediately, and sometimes they come quite a bit later. So let's just talk on this real quick. Again, I've gone over this a lot. So here was... you can see the last, well, not the last, technically last bear market was right here, in early 2020. But the big one, what they call the Great Recession, came back in the market topped in October of 2007. So if you can make it out here, right here, let me give you an arrow, was the top in the S&P 500 and Nasdaq 100. They both peaked in early October of 07. And you can see in late 2007, it gave a sell signal, an extreme too. Look how low that CPC. I'm sorry if I didn't mention what we're talking about here. I sometimes just jump into a chart, get going. CPC, that is the put to call, total put to call ratio. That has index options in there as well as individual stocks. And again, that was a great signal, and it marked the top. It came shortly after the top, but it got you out or warned you of that 56% bear market back there from October 07 to March 09 right there. And something to note, I haven't gone over this, just to the left of the chart, look at that extreme spike that came, and that was bullish. There was a correction, and that preceded that last leg up. The final leg up in the bull market was right there. Again, that cut off to the left. Well, it's not cut off. You can see it on the screen. That was in the summer, or early, actually, spring of 2007 right there. Looks similar to this big spike that we had right there on that drop, and then a thrust up here. And again, one thing to note is in a bull market, my buy line right here, that green dotted line, dashed line at about 153 or so on the put to call ratio, that's right here. That's my excessive fear time to go long or cover your shorts. And you can see it's done a phenomenal job. We had a sell signal here with an 18% drop, but it was pretty quick, and then right after Shortly thereafter, this one said, right towards the bottom of that drop, or a little bit before it, hey, excessive fear, go long. And so my point here, in a bull market, these were great buy signals that got you in each and every time. Sometimes a bit early. That one was a bit early, but there was another one right there. And if you took each and every one of them on just a one and done tag, you caught the end or darn near the end of a correction and got long for the next major leg up, including the one back at the March lows. So I wanted to point that out. Now, another thing I want to point out, and I haven't done this before, even though I've covered what I've just showed you a lot. Look what happened in the last bear market. What happened, and this is common, you after the first few corrections, you got that spike. And look, those signals did pan out for bear market rallies. So what it was is nobody realized until things got really ugly in 2008. The dip buyers were coming in. You get those signals there, excessive fear, and again, what happened is they weren't your long-term get back in for 401k money, long-term investing. I just want to mention that, and we will see that when the next bear market comes. Again, we had one here. Maybe that's it for the next. I doubt it'll be another 12 plus years like this one, or 10 years, but we'll see. Just wanted to mention that in a bull market, it's one and done there. Now, the buy signals right here, excessive fear. Sell signals on the bottom. That one, again, at the top of the 2007 market, it nailed it, pretty much nailed it. And then along the way, these were all bull market corrections. You got cluster there, 18% drop, a single reading followed by a 21% drop, a cluster of two followed by a 10% drop. So these are all the big corrections. There was a whipsaw. I point out all the time. I like to say that nothing's perfect, so I point out that cluster there that didn't really lead to much anything. That one came very close, and you had from said and done, from there to there, that was close to 20% drop right there. And here we go again. Fired right before the drop into the COVID lows. Would have got you out of the market or got you short or helped. Look, again, I don't use these as standalone buy and sell signals. We had other sell signals here, and we did go short there, and went down and milked a good part of that. And then again at the bottom, there were a lot of signals, divergences and everything else pointed out at the time that coincided with this extreme spike right there that said, hey, everybody's too bearish, time to cover some shorts and go long. That was again posted for with the 60-minute charts and everything else supporting the case to cover shorts and go long back then. And here we are. And this is where I know I'm talking a long time about this put to call ratio thing. These are extreme. This is an extreme cluster, much more persistent than these little three slight tags. We've had just extreme bullishness here. Again, you can see the lines. I know in the video it's hard to see. Let me know. I'll post a link to this chart below the video if anyone wants a copy of it, or a link to the chart. And here, I can zoom in. That's what I can do for you. Zoom in, and you can see the all those tight clusters, including another recent tag there. So I'm going somewhere with this, guys. I'll tell you that real quick. I have a point where I'm leading. These measures, these extreme readings are lining up with what I'm seeing in the charts right now. And then I have the other one, the CPCE, which is the equity only put to call ratio. So that doesn't include those index options. These are just individual stocks. And this is where the retail crowd's been going crazy. They're just foaming at the mouth bullish right now. Here, I'll zoom in for you so you can see. I was going to say, I don't know if you can make it out, but why not just zoom in since we're doing a video. And sure you can now see it there. This is the current cluster of readings, including this uber extreme drop right there, right there at the bottom. That just came last week or so. Right here, I'm trying to color it up for you, right color as you can see. But again, this is a persistent, a cluster persistently extreme bullish readings, and you can go back in time, which we'll do right now, and roll back, and you can see that's what we had back there, followed by a drop. Here, we'll zoom back out on the chart so you can see those. Go back out a little bit more. Nope. There we go. And so I like this one because it has a better track record than the total put to call ratio. Keep in mind that the other one, the first one I start with CPC, which includes index options, a lot of index put buying or call buying is actually hedging, and that's why I think you get a more pure play with this one, because this is equity only. These are individual stocks. In other words, what I mean by that, well, particularly with the institutional investors, they're more a little depth, and so they tend to hedge more than the retail investor. And so what that means is they'll have a portfolio of stocks. They'll have Apple and Microsoft and Amazon, everything that they have. And what they'll do, they want to hold on to those for tax purposes, the cost of jumping in and out. So when they sense risk, they will hedge up. They'll buy puts, and what they tend to do is buy puts on the indexes. And so therefore that may skew that. In other words, so if you buy a put option, which is a bet that the index is going to fall or a stock is going to fall, that's a bearish bet. But in the case of hedging, you could still be bullish. You're bullish enough that you don't want to sell your stocks. You just want to hedge up. And so the CPCE, equity only, this tends to be more of a pure play. You got a lot of retail traders, and this is, again, well documented right now, buying calls on stocks. And that's what this recommends. That's what this shows us. This is the ratio of put to call buying. When that gets very low, it means a lot less people buying puts than are buying calls. So it's an extreme in call buying, and it has had a 0 failure rate when we hit my line. Corrections have followed. A lot of times it's been a one and done. But like the other indicator, when I go back farther left, sometimes you get these periods of persistent clusters. Where am I going with all this? This persistent level of extreme bullishness, coupled with the fundamentals right now in the economy, the disconnect between the stock market and the fundamentals in the U.S., it leads me to believe, I keep talking about sell signals for the next correction. I think the risk of a crash now is even higher, and I'm not trying to be dramatic. This is not a public video, so I'm not trying to, sell subscriptions to the site. I kind of can't stand services that make every drama to sell things. But I just want to let you know, if I didn't believe it, I wouldn't be telling you now. So what do you do with that? Well, again, there's no sell signals, but if you're an investor, 401k money like that, and you've participated in this rally, don't underestimate how far and how fast the market can fall. And it does that. It doesn't do it randomly. It does it when you hit these extreme conditions. Again, the last time we hit these extreme conditions, again, I showed you, on the CPCE, the CPC was right there before that big drop into the COVID lows. So again, and this is one of many indicators, but this extreme and persistent level of bearish bullishness, which has not yet manifested in the form of a correction. These just little pullbacks along the way as each reading was hit. But this indicates, again, and historically these drops are all measured in double digits, and we haven't had that yet. We did actually take it back, at least in the Qs there was a double-digit drop in there. But again, this is telling me, chances are, and no guarantees, we're looking at a much, much bigger drop. So, and where does that all tie in? Well, I'm about to go into the charts in a second. I know this video is getting long because I'm spending a lot of time here, but one seemingly little, innocuous, let's call it, sell signal. Let's say the breakdown of those trend lines I've been posting lately on the indexes, or a breakout in the dollar, or all of the above. And that's why I spend so much time talking in these. It's not any one thing. It's a combination of a lot of factors. And when you're in a strong, extremely resilient uptrend, as we have been, you want to give it the benefit of the doubt, or you want a lot of evidence. I always use the analogy of, like, a prosecutor in a case. You have to prove that a defendant is guilty beyond a reasonable shadow of doubt. So you want to come in hard, and the more evidence you have against that defendant as a prosecutor, the more likely you are to win the case. And when you're trading, investing, same thing holds true. So it's been a extremely resilient uptrend. The Fed has been pumping this market with easy money and things like that, and so therefore there's been a lot of money on the sidelines buying the dips. And what you need to do is you need to see quite a bit of evidence I think if you want to pull most or all of your money out of the market, especially as a long-term investor, and or get aggressively short. So now we're going to roll into a few other things, and we'll get to the charts. But again, I can't impress the importance of what I'm seeing here enough. And again, as to how it formulates where I'm thinking, the next time we get a correction will be just a minor, hey, opportunity to buy the dip. Maybe so. Maybe this continues to persist. Maybe this doesn't play out, but it also could be the beginning of something much bigger. Okay, and it's not just your put to call ratios that are flashing warning signs. As I said, this is the AAII Bull Bear spread. That's the American Association of Individual Investors. They do a weekly survey among all their members, whether they're bullish or bearish, and the same thing. And you can see my lines. I have 2 lines down here. These are my buy lines right here, and this is when everyone's bearish. I have a green line there, and an extreme down here around negative 3.5, negative 35. Now that was the extreme back then. In recent years, this has become the new floor. This is where you want to step in and buy. And you can see we got a cluster around those lows. We had a buy signal there. Pretty damn accurate indicator. Again, look at this. Just look at when they trigger, and look at what happened if you were able to step in and cover your shorts and or go long. And the last time, well, here we are. We just hit my sell zone or warning zone. And again, like the other indicators, sometimes you get clusters and it takes a while for the signals to play out. And then sometimes it's one and done. So here was the last time we hit that back in, looks like 2018 right there. And that marked a major top. The market might have made a ever so slightly marginal new high, but you could have shorted there or got out of your longs. And it was about a 1 year, no, not a year, but close to it, drop right there, and a big drop, one of the biggest drops in years. So that signaled that drop. And here we are again. So it's not just any one indicator. It's not the CPC or the CPCE or the AAII. It's a combination of, it's pretty much all of them just firing, on all cylinders, telling you, hey, the market is just too, individuals, investors are too bullish right now. And the market just doesn't allow that for too long. It will correct that situation. And the other one to look at is the VIX. The VIX, highlighted this recently, the VIX tends to move concurrently with the stock market. It moves inversely, meaning one goes up, the other goes down. But quite often, I pointed this out many times in the past. I'm not going to go over all those examples here because this video is starting to get a little bit long. But it will have predictive value. The VIX will start moving up. Not only predictive value when it breaks out and triggers a buy signal first, but it also, just like the stock market, I look for those divergent highs, showing you that momentum is waning. In a stock or the stock market, I look for negative divergence. At the same time, you will almost always or very often see positive divergence. In other words, you get the bearish rising wedges or other similar patterns in the bearish patterns in the market with divergences, and then you get your sell signal on the break of that. And likewise, you have usually similar but opposite patterns, bullish falling wedges, positive divergence like you had right there. That was a big correction in the market. And again, the VIX warned of that, said, hey, there's going to be, this is a bullish chart pattern, the VIX, there's your breakout, and the breakout occurred, as I said before, in most instances a little bit before the stock market topped. So the VIX starts moving up. It has some predictive value there. How is that? Well, part of it, I think, is I believe the smart money institutional investors starting to hedge up and buy, because the VIX works similar, and it's a different methodology and formula, but similar to call ratios, and it's that's what it's based on, put versus call buying, and again, it will give you very often a heads up. And so we're watching the VIX as the stock market makes all-time highs. You can see lately the VIX has been actually rising, holding up. There's a small uptrend line. I pointed this out. We've been building divergence for quite a while. We had a little divergent low, well, not little, it was there. And you might say, oh, a little small rally in the VIX. No, the VIX went up 77%. Remember, the VIX is going to move big, and ultimately, before all is said and done, spiked right here. That was when actually that November, that key Well, I actually spiked a little bit ahead of it. Look, my crosshairs are on October 30th, and I keep harping on the November 2nd low in the stock market and a lot of assets that I'm watching right now. And so there, the VIX started to fall before that, a little bit of predictive value. And then the stock market started rallying right after that. And you can see now we have this uptrend. So here's what I'm watching. We have and had up to this point even larger. This is some of the biggest divergence we've had in a while. From here, from that divergent low, that divergence extended. And the VIX has been gradually moving up since then. And right now I've got 1, 2, 3 equal reaction highs right here about where we are today. So and this is not mere coincidence what I'm about to roll into. So the VIX is at an inflection, or not an inflection point, a potential breakout point, about 29.15. If it can pop that, I do have a resistance line there, but it's from a while back. I'm putting a higher weighting on these three right here. If it can pop that, it's going to run. And now, that's what I'm talking about. It's not mere coincidence. At the very same time, we have the S&P flirting with, it's under it today, and it's a breakdown. But if I want to give it the benefit of the doubt, I can move this trend line a little bit lower and capture this candle. Let me zoom in for you. See that candle right there from October 30th? That catches a low. I like the way I had this trend line better. I think this is the better fit, but this would be the benefit of the doubt line, which is under today's lows. This comes in and captures more reactions. So, always get this. How do you do trend line drawing? Trend line drawing is an art, not a science. Everybody does it different, but I go for the most number of candlestick shadows, that's the skinny part, and or bodies. The body's the fat part. And so to me, this is the most valid candle. Now, this is a daily chart, so all that matters is how the SPY closes the day. But as of now, it's a breakdown. It's a sell signal. It's an early sell signal. You can jump at the gun if you want. Take it now. I have to continue to impress the importance of tonight. Apple, Tesla, and Facebook. Three of the largest companies in the world, and major top components. So it's not just the weighting, which is probably the most important thing. The weighting in the indexes, the S&P and the Nasdaq 100, but also the psychological importance of those stocks being, market leaders. So that's all today. It can either, and it will either, build on this breakdown or foil it, and that's, I think, what I put in the post this morning. So there's a SPY, technically breaking down today, but again, you take a sell signal in front of the three of the largest companies reporting, you're just rolling the dice, you're gambling. And I'll give you my opinion, based on the posture of the charts. Sooner or later, I believe we break down, and what would be a better catalyst for that breakdown than, poor earnings or guidance from any or all three of those companies. So that could certainly be the catalyst, and that's why I'm doing this video today, and that's why I'm spending so much time talking about it. QQQ still above trend, and it's become a pretty good trend line. We have enough reactions. This is off the March lows right here. That's the COVID lows, a big drop. Another reaction, couple reactions there, and some more recent reactions. So this is the level that needs to go. And there's your potential targets on the Qs, QQQ. Let me change this. Each one, 297, 283, 267.50-ish. Those would be my near-term swing targets. Okay, another chart I've covered in the past as well as recently is another sell signal in the markets. Are these, I have the low volume indicator, I call it. I put a 10-day exponential moving average over volume on the major index tracking ETF. So this is QQQ, and you get these clusters, these readings here, and then you can see where the arrows are. So when you get down, I have a red and a yellow line, so it's more of a zone. The red line's at top, sometimes that's all it takes, for volume to fall through, and then the correction sets in, like right there. Boom, that was a drop. And this, I'm going to measure it out. It's not high to low because this is not candlesticks. Line charts show you the end of day close, so you could have a big range, you could have a big rally, up that day before we close, as well as usually at the end of a sell-off you get a big intraday spike, then a reversal. So when you use a line chart, it tends to underestimate the moves of a trend. I'm just measuring out 25% here, 12%. This one I know in the S&P was 36%, but it's only showing 28 there, and that's QQQ. QQQ fell more than 20% in the COVID lows, but that's it. So you can see the levels, the little arrows show when we hit those lines. You don't want to, right after a correction. Actually, we never even hit it there, so that one's really not even a signal anyways. We hit it there again. You can see them all here. And as I say, with just like the put to call ratios and other sentiment measures, even though this is not a sentiment measure, but like those, it's not a timing indicator. Sometimes you can have an extended persistent period of the reading. In that case, you can see the volume stayed very low. But typically, the longer, the more persistent those readings are, just like with that put-to-call ratio chart I started with, usually the bigger the drop that follows. So leading up to the COVID, I call them the COVID drop, the drop into the March 2020 lows, we had the most persistent and extreme drop in volume that we've had in years. And call it coincidence if you want, but that was followed by the biggest stock market drop in many years, not decades right there. And here we are again. So, I wish I could say with 100% confident that these will continue to play out, but all I can tell you is, some of my most reliable indicators are all consistently saying, hey, big move coming, big move to the downside, not to the upside. These aren't, and that's, we'll see. And history will show if I'm wrong, what will happen is volume will start to return to normal. You can see these bigger and get off these levels and without any correction, and the market will continue higher. Same thing with the put to call ratios that are still at extreme lows. You'll see that start to move higher with the stock market going higher without a correction for, let's say, the next 6+ months. In that case, we'll say, hey, guess what? That indicator, which has been reliable for a decade or more, had another whipsaw signal. I won't write it off. I'll revisit it again. Every now and then you get whipsaw signal or false signals on just about any indicator, and that's why if there was any one perfect indicator, everyone would use it and everybody would constantly make money in the market. And likewise on SPY, the S&P 500. My low volume indicator, same story. There was that persistent period of persistent low volume in the S&P leading up to the big drop, that 36% drop into the COVID lows. There was a cluster. You can see low volume cluster right there before that drop back in the fourth quarter of 2018-19. And keep in mind, both of these times we had sell signals that we were able to identify on the daily and 60-minute charts that confirmed get out of longs and get short. So it wasn't just this. This just happened to confirm and tell us, hey, it's probably going to be a big correction, 10% plus instead of a little 5% pullback. So that's where I think you can get some useful and predictive value out of these readings. It allows you to, decide, hey, do I want to cover at T1, the first target, or do I want to hold out for T4 or T5? And I'm just referring to, I usually list multiple targets on my trades. Now let's get into those. I'll probably have to wrap the video up here and not get into all that. I have some bunch of trade ideas I wanted to cover. We'll see. There's not too many, or I can limit that. But one I want to talk on is XOP, and there's a great example of what I'm talking about, multiple targets. We're right at, as I just spent the entire first part of this video talking, or a good part of it, we're right at some major inflection points where the SPY, if it goes much lower, will break down. QQQ's got a little bit of work to do, but it'll break down and give us those long-awaited daily sell signals on the daily time frames. Or they hold above trend, and the uptrend continues, and we'll just watch all this stuff, and that means we'll probably see new highs in the market. And so here's an example of why I list multiple targets. On XOP, I gave you, this was more so than a target. It was the first, there was a support level that needed to break, and it did, and gave us our next sell signal. So we started short in XOP up here. Then it broke the trend line, and then that level, and that was a catalyst for a move down to my first target. So the XOP I've maintained, and I continue to maintain, I prefer a swing target down here, 57, just about 57 on XOP. However, if the market doesn't break down, if all those things which are just on the cuffs, if we don't get those sell signals, and the dollar doesn't break out, I'm going to get to that in a second, then that's it. We effectively hit my first target. I always say if you don't see T1 equals, T2 equals, those are unadjusted targets, meaning I haven't adjusted. You always want to step in before the actual support level, because if too many eyes are looking at it, it's pretty obvious. You're going to see the buyers quite often step in early. So I always adjust my targets up early, and I cover short positions a little bit above the actual support level where I expect a reaction. And just like on longs, I'll sell them a little bit below the resistance level I expect a reaction. So what's happened? We've effectively hit my first target, and that if the market doesn't break down soon, then that's probably going to be it. You could have covered DRIP for, DRIP was the preferred proxy for the trade. We entered it somewhere here. And today, when that XOP hit that, first target, that was about a give or take 22% gain in XOP, or I'm sorry, in DRIP. We popped that trend line. I did say that we had to take that trend line out to get the next sell signal, but here's why. I've said it time and time again. XOP takes precedent. The chart of XOP and what happens there by far takes precedence over anything that happens on DRIP, because DRIP is leverage. You're going to have decay and distortion in the charts. So the fact that when DRIP broke out here today, at the very same time, XOP was just a hair above and reversed above that support level, that's why DRIP broke out and had a whipsaw signal, because XOP is the actual sector. This is just leveraging, and again, I told you it distorts the charts. And go back to XOP, what you're looking at is we're seeing quite a few of the stocks break down. Here's ExxonMobil, for example. This is the largest stock, at least in there by market cap. I don't believe it's the largest weighting. It is included in XOP, but I have a BOD line, a benefit of the doubt line, right here. I'm going to turn the color up, and that is because see ExxonMobil. This was my preferred trend line because I get more reactions off these three candles. But if you come in here, catch the bottom of that one, actually it moves. That's one thing I don't like when I roll, scrolling on this chart or zoom in. There it is. That's the benefit of the doubt line. It comes in at the bottom of that candle right there, and that's so far what ExxonMobil hit. So same story. We need to go a little bit below today's lows. It'll break support on XOP. It'll break, if XOM breaks support, that's going to certainly have an impact on the sector. But as of now, what all you saw today is simply a drop to support in XOP, most importantly the sector, as well as a lot of like market leading stocks like this, or well, used to be a market leader, no longer a market leader. Chevron has hit support, but it's also broken trend. So I remain bearish because a lot of these, the majority of these stocks, or maybe not the majority yet, but a good percentage have already broken down, like COP. I'm just going down the line in order market cap. And so when I go through this, this is what tells me today's bounce in XOP and that hit of T1 was probably not the end of the drop, because a lot of these stocks have clearly broken down as I'm just thumbing through these charts. And those that haven't, this one broke trend, so you have the trend line on MPC broken, but you didn't break that key 44.12 support. You broke it intraday, but again, there's the lesson. That intraday pops and reversals and drops down through above support and resistance are more than common, and that happens a lot, especially in volatile sectors. You want to put a higher, increase the odds substantially. MPC's going lower. Wait for a solid close above 44.12 or a big intraday drop that has very little chance of recovering, especially later in the day. If you break down in the morning, there's 6.5 hours in a trading day, plenty of time for a stock to recover. But if it's, you're heading into 3:30 p.m. And you see MPC way down here, probably not going to get a stick save, and that point you might be able to short before the close, and get into that. So that's it. I just wanted to kind of go through a lot of these stocks breaking down, and those that haven't are right on support. So I think we're at a pretty key inflection, or not inflection point, but a key technical level here on the energy stocks. And then it all comes back to me at least, the dollar and the euro. I've been talking about that quite a bit lately. And there's a level. I gave you an update this morning. You know, the dollar broke out, put in a divergent low here. It's been moving up, but it keeps hitting my 96.11 first target. I mean, we hit it here when we pulled back. Hit it again. We had a little whipsaw. I'll give it that. That's a whipsaw signal, false breakout. Then we hit it there, pulled back. And today we broke out, and it's still a breakout. We're back testing right now. I don't know if you can see it, but zoom in. Right on that level. So again, it aligns with everything I'm seeing. The stock market right on support, the S&P just cracking, QQQ below. So if we can get a little more upside in the dollar, which means, of course, a little more downside in the euro, E7 euro futures. Look at that. Just that's why I'm doing this video. I'm seeing all this stuff happening today. We hit that previous reaction low. Remember my support second target, which was hit, is at 120.91. But as I said before in the recent videos, when you overshoot a support, a slight overshoot, that's now your reaction low. So that's what traders are watching. And so I believe I said it in recent videos, you know, that we of course we need to take out 120.91, but more importantly, we need to take out that previous reaction low in the euro, and that's exactly what we hit today, and that's where we bounce. So, and that is, you think it's coincidence? It is absolutely no coincidence. That's where the stock market started bouncing. That's where crude oil started bouncing today, and that's the reason XOP bounced. You know, here's crude oil. Crude oil at the very same time, it's, you know, was dropping with the euro when the euro was dropping and the dollar was rising, and then once the euro hit that previous reaction low and reversed, and the dollar hit resistance or was right out there, the crude bounced, and that's the bounce this morning in crude. That this jog up right here, and again, is it mere coincidence that XOP at the very same time turned around this morning? That's when crude bottomed. That's when the euro bottomed, and they went up. Okay, so that's it, guys. A lot of stuff. I'm talking fast, but it's all interrelated. And to keep it very simple, that's it. We just need that nudge. We need that, you know, solid sell signal. We need to see a little more downside in the S&P 500 or solid close there. But even if the S&P, which it's broken down right now, got to have the Qs break down. And I'm doing this video because the potential catalyst would be Amazon, tonight after the bell, Apple, Facebook, and Tesla. Those three are very top-weighted heavy components of the NASDAQ 100, and it can go the other way. I'm just laying this out in advance because it will do you no good for me to sit there tomorrow at noon and do a video if the the market didn't like what they say and we see a big red candle. Because of everything I covered in the beginning, I think this market's like a powder keg. And when you finally get a rush for the exits, that's what it'll be, since everybody's long, and that's what I talk about. And that's why I talked about the potential for a crash early on, after an extended period of excessive call buying, very little put buying, also shorts being blown out of the water like they're getting squeezed out in GameStop right now, things like that. What happens is you don't have that put protection in the market, and so when you start to fall, and you don't have a lot of shorts if they've been squeezed out, and that's what leads to those crashes. Most people don't understand where crashes. They don't just randomly. You have to have certain ingredients in the market, and that's all I'm saying is right now those ingredients exist. Doesn't guarantee that it's going to manifest or play out in the form of a crash, but if you're ever going to get one, when I say a crash, I'm talking just a very swift drop of over 10% or more. Can either start out gradually with a slow roll and then build momentum into a crash, or it could just come pretty quick, almost with a flash bang. And the thing is, there'll be headlines. I guarantee you, if there's not a reason for it, it'll be a technically induced sell-off. But I promise you, as I've always have, the media will come up with some headline. It never fails to amaze me, even how unrelated to the actual drop it is. They'll cite the reason, more fears of COVID or virus strain or something to do in Washington in the political arena, or something else. We'll see what it is. Okay, video went too long. I'll cover the other trade ideas, which includes Bitcoin, Riot. And those are updates. I already covered those. GameStop, still waiting. We need to see those 5-minute trend lines break. I want to make an update on the semiconductors. And then anything else that stands out. So I'll do that in a separate video, but just want to kind of paint the, with a broad brush, the bigger picture on the market, and that's it. Trend is up, no sell signals now, but we'll keep an eye and see if we get some soon. 1 second here, guys. My mouse just died. I was going to wrap the video up, and I have to plug in the wireless mouse because I can't get to the stop button. All right, here we go. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.